Welcome back to another episode of the Anatomy of the Trade. Today we're going to discuss a trade that I've done in Kodiak Sciences. Let's have a look at that. And here we are having a nice uptrend, and then we are going into a consolidation, which I'm thinking that this is a reaccumulation. And then my first point of entry is right at the bottom, so I was actually really happy that I caught that particular bar at the bottom. And as the rally develops, definitely, there is profitability there with my options position. The whole idea behind this move is whether we could overcome this resistance on a sign of strength rally, or and then back up and continue to the upside. That was kind of the original plan for the trade. Or we would, alternatively, as scenario number two, come to the upthrust condition and then fail from there. And as you guys know, those who attended our WTC course with me, that this is a kind of like a very typical trade that might fail, right? So we want to analyze it from obviously mechanics point of view, whether everything was done. Was the point of entry correct? Was the exit correct? Because these are allowable trades that give us an opportunity to be in something that might potentially actually work out. In this case, it did not. And then once it did not, then you have to ask yourself a question. What was wrong about the analysis? So where did we either misjudge a bias or timing? So these are the questions that we're going to try to answer during this session. And then after the exit, another point of entry here at another low, just a little bit later on, not on the actual low. And then there's no traction here to the upside. So just again, collapse of the premium. So this was a losing trade. This was a kind of like a break-even trade. So altogether, definitely, there is no profitability in these two trades. So Franz, from the first look of these two trades, what are your first initial thoughts without just going into the comparative analysis?
Well, the first thing I'd like to do, which you started to do, would just kind of be to delineate the support and resistance of the trading range that's developing here and where you draw that. And so we can kind of see the activity within the trading range itself, and reading the volume characteristics. We want to see, after the initial kind of collision of supply and demand that occurs at the beginning in phase A, as we enter the trading range and the change of behavior occurs, we can see that. We see that the volume signature across the trading range is on the way down, especially in early 2021, and then we see that that increase, which certainly has characteristics of phase C, right, Roman? I mean, after this exhaustion, we want to see the final kind of supply being presented, and I think that's what you're seeing here, right?
Yeah, I think it's the volume signature is very subtle here, and maybe just because of this volume spike. So whenever we have that, you can't really like see this really well on the volume, but generally, Franz described this correctly. So with the diminished volume, so we're thinking that this is a diminished supply as well, and we're seeing slightly up tilting structure. So there's still the momentum that carried us up is decreasing, but because of the previous momentum, strong momentum, we have a tilt up. So when we go into the potential phase C, it is allowable to increase the volume signature because this is where demand is coming in and picks up some of the supply that is available. And indeed, it happened exactly in this way. It's just that there was some buying on the way down, and then there was no buying after that. Demand just diminished significantly, and that's why upthrust was produced. What else, Franz?
Well, and then into your second area, your second point of entry, we're looking at a potential spring here because that late February second downswing slightly undercuts the previous level of support and then bounces back quickly. So, definition of a spring, the problem that I see here is that with a truly a real spring, you want to see continuation well beyond kind of the middle of the previous trading range. And I think what you're giving it a chance to do here is maybe test in early March, but after that, again, as you said, there's just nothing happening. So there's the little test. Actually, the demand bars that occur after that are pretty weak. So just at
But
that point, you can see,
yeah, we obviously kind of have to think. The dilemma is what's happening here. As we open the positions and they don't work out, right? So this is just the outcome of that decision. So thinking more about this and kind of like trying to capture more nuances here, I think the increase in supply going into this spring, I mean, we would say that spring number 2 should have the increase of the supply because weak hands are going to capitulate whatever they have at that moment, and strong hands are going to pick it up. So that's why the volume is generally going to increase. So we see that. But still, going with the increase into the spring does not necessarily work out every time. Secondly, there are 3 types of textures that we see here in the trading range. So the first one is more, as I said, a continuation of the uptrend. Supply comes in, and that stops the movement up. So this is just a drift up of the momentum that we've had before. Then the second texture is once we're done with this drift, we have some selling, right? So, and maybe that's how it should have been seen in the moment. So at 2 spots, selling is increasing, so we're changing that texture. And then the third one is just like a drift without any purpose, right? So there is a volume contraction, and there is, look at the spread. Everything is just diminishing. There is lack of interest at any point. There is no heavy demand, and so on and so forth. So probably just mistakes seeing this type of change, where we're going from being very strong to then slightly weaker, still suggesting a reaccumulation, but not suggesting any type of breakouts. And then once they sold in this area right here, then it just kind of like drifts and we don't have any interest in it. Well, another thing was maybe the clue was the comparative analysis. And when we do that, we want to look at the group. Here it is IBB. This is a biotechnology group that the stock belongs to. And this is NDX, NASDAQ 100. So Franz, what do you see there on the comparative side?
Well, it's interesting. The candidate Kodiak initially in early September is dramatically outperforming both of the kind of the indices that we were relating it to. So we have a very strong rally while basically NDX is going flat to nowhere, and the same with IBB. So we can see that the initial move in this candidate is quite strong relative to the comparative, and then it's more like between about December, after kind of late November, after this candidate kind of loses its mojo, it's almost like the 2 comparative indices are just catching up to it. So that's sort of what I see, although you can see that it is starting to lag the overall performance. And maybe the train is pulled into the station. It's just going to sit here for a while. And again, where you've indicated those second two S with a circle around it, we can definitely see a pronounced underperformance at this point by Kodiak, and maybe that's something else that you'd want to look at and see. Well, okay, is this still a leading stock, and so on and so forth. But then after the peak at the second Kodiak, it's out again because against IBB. IBB is making a lower low on kind of two levels, just eyeballing it. It doesn't look like Kodiak is as weak, so a little bit of outperformance there. It just kind of moves along with the overall biotech index, and Nasdaq is a little bit, or NDX rather, is a little bit stronger towards the end. But I think when you get that initial surge in outperformance, and then it kind of peters out, and the other indices catch up, and then everything kind of just goes into the basket and the hopper there for a while from early February on. It's clearly biotech has dropped off the radar screen of institutions for the time being.
Okay. Well, I think the key here is asking ourselves a question, what was the mistake in the analysis, right? Was there any clues that would maybe not get us into the position, or maybe would get us into the position and would get us earlier on the recognition of something is going wrong? So we've talked about the volume signature, right? So we said supply is increasing as we are starting to develop the reactions. The texture changes. So in a way, a change of behavior has happened here and not necessarily here. But then, coming back to the comparative analysis, I think, Francis' point about this September action, where we have so much strength. So the stock is coming out of the trading range formation. There is a lot of strength relative to the NASDAQ and relative to the IBB. And that shows the potentiality of the leadership of the outperformance. And we see exactly this on the whole rally. So here we are coming with an assumption that this weakness will reassert itself into strength, and obviously this is not correct. And then as we go into the second point of the entry, and this is important because if we would be comparing IBB to NASDAQ, we could see that IBB, the biotech group, is definitely weaker than NASDAQ itself. So therefore, maybe not the greatest stock at this point of time, because here we're seeing how IBB is firming up, and it's actually stronger than flat NASDAQ. It's kind of trying to rally here. So we want the strength of the whole group to help out a specific stock that which we think is going to become a leadership stock. And we just don't see the help of the group here at all. What we're seeing more is a change of behavior in itself, in this reaction, relative to all of the previous reactions that we've had in this index. And that signifies a change in the environment, so change of behavior, and just kind of like ill-timed from the comparative point of view, how the group is behaving and so on and so forth. So I would say that those are probably, two mistakes. So if into the comments I would put increased supply into support. Then secondly, textures, different textures, and specifically change of behavior, I think was identified incorrectly. This is a true change of behavior. Thirdly, comparative analysis of the group. that was important, and also of the market itself in DX. And then as we go through the bias, so bias definitely identified incorrectly. I mean, even the first trade where we had some profitability going up, that's not what was the plan for this trade. So the bias here is a trading range, not an uptrend. So a definitive no. Timing, I would say probably yes, Franz, right, in terms of the actual entries.
Definitely yes. I mean, right at the low, so good
Okay,
entries.
character is definitely no. Point of entry, yes. Stop loss, yes. Add-ons in not applicable. And then exits. Well, I wouldn't say that the exits were bad. I mean, like when you analyze your trade, you can't really think about a losing trade being a bad trade. Never judge it by the binary loss or a profit. Judge the trade by the execution. So what I mean by that is under the circumstances where you're producing a loss and you made an analytical mistake of what the environment is, what's going on, and so on and so forth. The key is for the exit to be correct is to exit at the correct time, even if it's a loss. And you should judge your trade against that thought, not against like a loss or the profit. So here I would say that I'm actually very satisfied with this exit. Here, I think this could have been a little bit earlier, but I saw a little bit of the diminished supply. So I was trying to see if we're going to have another pull up. So probably an earlier exit would be a little bit better. So, but still exiting on the failure, I'm probably going to say yes.
Yeah, that's a good exit.
Okay. So then we have
4 out of 6 for 66, right?
yeah 67%, and you could see that it's so interesting. Sometimes you have the variance that is even lower, but yet you have a profitable trade, and then sometimes you have a variance that is high and you have a losing trade. So the question is like, why? Well, very simple, because certain elements of your trading, right? So for instance, where you closed it, how you moved the stop loss, or where your entry is, are having significant weight on the variance. All right, Franz. So your final thoughts on this exercise? Any comments, lessons, in addition to what we have here?
Well, for me, by far the biggest takeaway is the being in a group that has a leading industry strength.
Yeah.
Because I mean, otherwise you're swimming upstream instead of going with the current.
Yep. I would say that this is such a great comment. Yeah. So always try to see how the group is behaving. Is it also ready to go? And especially with swing trading and with options trading, where the timing is crucial and the participation of the majority of the stocks in the group is also important to carry your trade with more ease to the upside. So yeah, a definitive mistake there. All right. Well, thank you so much, guys, and we'll talk to you next week.
Thanks, Ramon.